Welcome to this explainer. Today, we're diving into what is essentially a high-stakes system of financial detective work. You know, the stuff that keeps our entire global economy honest. Every single day, literally trillions of dollars change hands based on the financial health of companies and governments. But how do we actually know those numbers aren't just completely made up? Well, that's exactly what we're going to unpack right now. Since we're translating some pretty dense accounting rules today, here's our quick roadmap. We'll hit the need for audits, compare the different audit types, walk through the 5 audit phases, look at rights, duties, and reports, and finally, finish up with the ethical auditor.
All right, Section 1, the need for audits and the universal problem of trust. Let's look at this universal problem. How do we know we can actually trust the numbers a company reports?
Think of a company's financial statements as its report card. They show everything, right? Earnings, debts, assets, liabilities. But imagine if students got to write and grade their own report cards. Yeah, it'd be a mess. We absolutely need independent verification so that banks, investors, and even employees can trust these figures enough to make massive economic decisions. So the solution to this big trust problem is the audit. Officially, the International Standards on Auditing, specifically ISA 200, defines an audit as the process of expressing an objective, unbiased opinion on those financial report cards. It's actually not the auditor's job to prepare the statements. Management does that. The auditor's sole purpose is to step in, check the math, and declare whether the info gives a truly true and fair view of reality. Moving on to Section 2, comparing audit types and knowing the players. Interestingly, not all audits are the same. So let's quickly contrast the different players here. First up, there's a really sharp contrast between internal and external audits. Internal audits, those are routine, regular checkups done by a company's own staff, just to help things run smoothly. External audits, on the other hand, which are the heavy hitters we're focusing on today, are usually done once a year by independent experts. Their whole goal is to give outside investors confidence that the financial reports are accurate. We also need to look at who is actually being audited. In the private sector, businesses pay external firms to reassure their shareholders and lenders. Simple enough. But in the public sector, the focus shifts to government bodies, like city councils or central ministries. There, the ultimate goal isn't profit. It's making sure taxpayer money is being spent wisely, legally, and with total transparency. Section 3, the 5 audit phases and the detective's playbook. Let's see how an external audit actually works in practice. So how do you even begin to verify the finances of a massive multinational corporation? You need a strict, standardized playbook. It's not just showing up and looking at some receipts. It's a highly structured life cycle to ensure absolutely nothing slips through the cracks. The playbook flows logically through 5 steps. It kicks off with pre-engagement, where auditors figure out if they can even ethically accept the job. Then comes planning to spot where the biggest risks of fraud or error might be hiding. Next is conducting the audit, followed by completion and review to evaluate the evidence, and finally reporting, where they issue their official opinion. Let's zero in on step 3 for a second, because the real detective work happens right here in the conducting phase, often called field work. This is where auditors are literally on the ground. They're running tests, gathering hard, sufficient evidence, not just taking people at their word, and meticulously documenting every single conclusion. It's incredibly rigorous, and the whole thing has to be reviewed and signed off by a senior engagement partner. Okay, Section 4, rights, duties, and reports, and the rulebook. Because an auditor can't just walk in and demand private records without a strict set of rules. The foundational rule, or really, kind of the psychological baseline for any auditor, is maintaining professional skepticism. It basically means having a perpetually questioning mind. They never take management's word at face value. If a manager says, hey, trust us, the money's there, the auditor's default setting is, okay, prove it. They are constantly on high alert for anything that might hint at an error or fraud. And they have to pair that skepticism with professional judgment, because auditing isn't just checking off a basic list. It's honestly an art, informed by years of training and experience. Auditors use this judgment to make highly technical decisions, like figuring out what counts as a material misstatement, which is just auditor speak for an error big enough that it would actually change an investor's mind. To empower them to actually do this difficult job, laws like the Companies Act 2021 grant auditors some incredibly sweeping, almost aggressive legal rights. We're talking 24/7 access to all accounting records. They have the absolute authority to demand explanations from any director or employee,
Plus, they have the right to receive notices for, attend, and speak at shareholder meetings. Basically, they're given serious teeth so management can't just hide things. But in exchange for all those immense rights, they owe a massive duty to the public. They have to produce a highly structured formal report. This report details the exact scope of their work, confirms whether proper records were actually kept, and unequivocally states their opinion on whether the financial accounts comply with the law. It's a heavy responsibility perfectly designed to balance out their power. Section 5. The Ethical Auditor and Guarding Independence. With all this power, how do we know the checkers aren't being swayed by the companies paying them? That brings us to our final section and this intense ethical tightrope auditor's walk. It forces us to ask, what exactly threatens an auditor's independence? Because if an auditor is compromised, well, their entire report is worthless, and trust in the whole financial system shatters. The ethical framework maps out these threats and demands very strict safeguards. Take self-interest, for example. If an auditor owns shares in the client, they're suddenly financially motivated to ignore errors. The safeguard? Sell the shares immediately. Or consider the self-review threat, where an audit firm checks its own bookkeeping work. The fix there is absolute. Just don't provide accounting services to the people you audit. And if a threat is simply too big, like say a staff member is planning to go work for the client, you just remove them from the audit team entirely. So after all this rigorous verification, the fieldwork, the skepticism, the strict ethical rules, we arrive at one final, super provocative question that anyone participating in the economy really needs to understand. Does an audit mean the numbers are 100% flawless? The answer is no. Actually, an audit only provides reasonable assurance. While this incredibly thorough system catches major errors and deters massive fraud, it is absolutely not an absolute guarantee. Auditors sample data, they don't test every single penny. This leaves us with a pretty profound realization. The global economy relies on this intense system of ethical verification, but it still leaves us to navigate the inherent, unerasable risks of the financial world. So if the ultimate financial safety net only offers reasonable assurance, how much risk are you unknowingly accepting in your own financial decisions? Thanks for joining me on this explainer. I'll see you next time.